Hello and welcome, and today we are covering International Flavors and Fragrances stock, ticker IFF. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. This company has a market cap of $18.8 billion, enterprise value of $27.3 billion, so a significant $8.5 billion in net debt on this business. That's almost a third of the overall enterprise value, quite a significant amount. They're operating in the chemicals industry, which tends to be fairly capital intensive. They operate they sell cosmetic, active, and natural health ingredients for use, looks like all around the world, basically. 4 segments: Nourish, Scent, Health, Biosciences, Pharma Solutions. So doesn't really mean much to me, but basically they're going into a bunch of different industries, focusing on the scent, but particularly these active and natural health ingredients. So it sells its products primarily to manufacturers of perfumes and cosmetics and other personal care products. Okay. Let's see. So return on invested capital. They were profitable every year from 2000 to 2021. So that's a pretty good sign. The only unprofitable year is last year, 2022. Otherwise, they were profitable for 21 straight years. That's actually really impressive. And I would say, or 22 straight years, that's a good mark of a high quality business. I think something I struggle with here is when I see from 2002, they had a 10.5% return on invested capital, all the way up to 2014, 17% invested capital, and then 2016 to 14%. They had steadily improving returns on invested capital, and their returns on invested capital were always above 10%, which is the hurdle that I want to see on a good business. So if I'm looking at this company in 2014, 2015, 2016, I'm thinking, hey, this is a great business. They're growing well. The returns on invested capital are both stable and improving. It doesn't appear very cyclical. You see here in 2008, 2009, they did come down a little bit, but they bottomed at 10%. All of these things would suggest to me this is a very high quality business that I would be interested in and I would want on my watch list. The concern that I have today is if we fast forward, the returns on invested capital have fallen off a cliff, down to 9%, 4%, 4%, 3%, 1%, and of course last year they lost money. And that's a major concern to me because it's suggesting that the incremental returns on their capital are getting worse and worse and worse. And so I would look over this past history and I would have been wrong if I invested in 2014, 2015, because these results have gotten quite poor. So it's a big question mark for me because I would say right now, today, based on recent history, this is not a high quality business. Now, if they can return to the history of 2012 to 2016, it would be a high quality business. And so just something to be aware of here. I'm much more interested in this period of the history than the most recent 5 years. You see the 10-year median returns, 7% return on invested capital, 13% return on equity. Neither of these numbers hit my target of 10% and 15% respectively. So for that reason, it's not hitting that high quality bucket today, despite these really good past results. Now, this PE number is obviously useless. Of course, it's going to be heavily distorted by this 2022 number, so I'm not really concerned there. We're going to have to assess the profitability on another metric later. Now, their 10-year CAGRs here are very impressive. 16% return revenue growth, 27% asset growth. Now, these two numbers, despite not having, EPS growth rates because you ended on a negative, are actually very instructive for us because what we can see clearly is while, yes, 16% revenue growth is very impressive, you want to own companies with 16% revenue growth. You don't want the asset growth to be higher than the revenue growth, and you definitely don't want the asset growth to be 11% higher than the revenue growth. What this shows me is exactly what we see here. If you take a 10-year period and you go from 2012 where you're earning 11.8% return on invested capital, and then you grow your assets 11% faster than revenue, you're going to crater your return on invested capital because now your returns on invested capital are getting worse and worse over time. If you want your returns on invested capital to improve, you need to grow your assets slower than your revenue. We're not seeing that here, and so you're seeing this reduction in the return on invested capital. Lots of companies can grow rapidly if they're willing to settle for low returns. That's not what you would want as a shareholder. Now, let's look at our revenue growth. Again, we go from $2.9 billion to $12.4 billion. So you 4x to revenue in the course of a decade. That's very impressive growth. As I said, that looks really good. Now, there's a massive jump from 2020 to 2021. So I have some concerns that you probably have some major acquisition here taking place that is impacting these results. It's going to impact this growth rate because you can see their growth rate before then was very different from this 10-year CAGR. 4%, 4%, -2%, 3%, 9%, 17, 29%. So three good years here from 2017 to 2019, -1%, 2020. But it's clear that you're not growing at a stable 16%. This is a massive growth here. So I'm going to guess we're probably going to see a lot of goodwill entering the balance sheet in that 2021 time period, and that's going to be a big player here in our revenue growth rate because you can see that they doubled their revenue over a course of a single year there. Now, the concern for me as a shareholder is you doubled your revenue, but your operating profit hardly went up. It barely went up here from 2020 to 2021, and you're still below your 2019 number. Now, it did improve again in 2022, but you can see the operating profit isn't doing amazing with this acquisition. You created your gross margins, so the new business is much worse than the old business, and your operating margins have cratered as well. So you're still below those old operating margins. It makes it hard to assess because we can see that your earnings peaked, in 2019 at $4. You actually had $5 in earnings in 2014. So this is really interesting. Even from 2013 to 2020, before you include that acquisition, this business had not grown sustainably. $4 in earnings, $5, $5, $5, 3, 3, 4, 3. So you end this 8-year period worse off than you started. That's a major concern for me. Despite the fact that you grew a significant amount, you grew over 50%, looks like 60 to 70% over that 8-year period, but your earnings were worse off. That's not what you want to see. You see their dividends grew rapidly during that period to almost match their earnings, and then of course they've slowed since then. So they're using a lot of money on dividends that they really don't have. You can see that over the last 2 years, they basically lost $6 and they paid out $6 in dividends. Major concern for me there. Let's see our dividend yield here, $3.20. $7, so maybe a 3 or 4% dividend. So a decent dividend yield, but again, they can't support it on their earnings, so that's a big problem for me. Now, this EPS number, of course, is being distorted almost undoubtedly by some sort of one-time impact because you can see that their operating profit was still profitable. So we're going to dive more into that on the income statement and balance sheet. But if you're enjoying this video, hit that like button. Don't forget to subscribe. Let's go to them now. Income statement. So big jump in cost of goods sold. So this is where you're seeing this gross profit number. You can see the big jump in SG&A. Again, everything here is looking like, hey, we made an acquisition. Big jump in R&D. Here we go. Other non-operating income. This is what I was looking for. So I'm going to guess this was a write-off. So they probably made a very big acquisition price in 2020, 2021 that led to this big jump in your revenue. But they're probably having to write off about $2.3 billion worth of that acquisition in 2022. Maybe they overpaid. The results haven't shown up. But that would be what I'd guess. It's really easy to ignore write-offs and say, okay, well, this isn't a real cash number. But if this is attached to the acquisition they only made 2 years before, that's a real loss. That is a loss that impacts the past returns because they spent your money that you made profits on. So you made profits on, 4 years of profits here from 2018 to 2021 was spent on that acquisition and written off. And so it's all taken out in a loss. So you lost basically a 5-year period with no profits because of the bad acquisition made by management. So it's easy to just say, hey, let's ignore that, but you can't ignore it. It is a problem here. And then on top of that, this is a massive concern. Let's look at our shares outstanding. Shares diluted went from 82 million to 255 million over the course of a decade. They tripled their shares outstanding over the course of a decade. They doubled it, more than doubled it in this single year. So they used stock to purchase this acquisition, which they then had to write off only 2 years later. This is a major problem. So this is how you can have the impact where your operating profit has gone up, but your EPS has cratered. This is why you don't want to see companies using stock in acquisitions. This is why you don't want to see stock companies doing dilutive acquisitions or just diluting in general, because this is a massive headwind for your shares. It's hard to really calculate even how big of a headwind this is. To triple your shares in a decade, you're going to basically have to dilute at something like 12% per year. Now, a big jump occurred in a single year, but if you think about a decade type return, that's like a 12% headwind on your results. So if you're growing your revenue at 16% a year, what you really need to do on a per share basis is say, hey, yeah, I grew revenue at 16%. I need to subtract 12% from that for the dilution. So really my revenue growth rate is only 4% a year. So what starts out and say, hey, this is cool. We're growing our revenue at this rate, 4% a year. But you actually then grow your assets at 27% a year while your revenue per share only went up 4% a year. This is a massive, massive problem in terms of for shareholders, because what it means is, yes, you earned $5 a share in 2015, but can you ever get back to that? Can you ever recover to that number when you've already tripled your shares since then? And my guess is you might not. You might take a long time. This has been what looks like, based upon the results so far, massive value destruction. So that concern alone would be a reason that I would stay away from the stock. You can see it looks like two big jumps in your assets here. So in 2017, 2018, they made an acquisition that tripled their assets from $4.5 billion to $12.8 billion. So let's see. If we go back here, yeah, you can see the big drop off here, 2017, 2018, cutting the return on invested capital. Why did the return on invested capital go? Because their earnings didn't go up. They made an acquisition for $8 billion and their earnings per share did not increase much, less than 2%. This is a massive problem. You can't increase your assets this much and not get a return from it. You need to see those instant results. Now, if they had tripled their assets and tripled their earnings, it would work out really well for shareholders, but that's not what we see. So you can see that they tripled those assets without an impact on earnings. Goodwill goes up $4 billion, and other intangibles goes up $2.5 billion. So you're about a $6.5 billion in the hole there on those numbers alone. And then 3 years later in 2020, 2021, you see that they made another huge acquisition. They take their assets from $13 billion to $40 billion. And you basically add $11 billion in goodwill, $7.5 billion, $8 billion in intangibles. A massive acquisition here. Now, again, you also add some PP&E. But this is overpayment. What this means is this is definitely, if we go to cash flow statement, it's going to be a write-off. It's not going to even show up there. This is definitely the write-off for this acquisition. They overpaid. Now, it might have been for this acquisition or that acquisition. I don't know. But what you're seeing is you see these massive acquisitions, but where's the net income? It's not here. You're not getting anything more. You're worse off today than you were before these acquisitions on a net income basis, and triply worse off on a per share basis. This is massive mismanagement for me as a shareholder for my interests. You've seen debt go up. You now have $10 billion in debt. You had less than $1 billion before, so you've 10x your debt in the course of a decade. Pension liabilities, all sorts of reasons to stay away from the stock. So the point of this analysis, because at this point, I'm not investing in an IFF, and it won't go on my watch list. There's too many red flags. But the point for you to learn is that you can recognize these red flags quickly. Here we are in a 5-10 minute video. I've been able to identify the key drivers for what's happened in this business over the last decade. We can see what was a good business has been steadily destroyed from a shareholder perspective since it peaked in 2014. We've identified the reasons. You've made some bad acquisitions that have not driven bottom line results, and they've overpaid for them such that they've already had to have write-offs in the last year and a half. So those reasons are setting up very poor future returns for a shareholder. So when in the past we might have expected double-digit returns, I can't expect that in the future, and for that reason, I'm avoiding international flavors and fragrances. If you learned something from this video, hit that like button. Don't forget to subscribe, and I would encourage you to check out this software, quickfs.net. My affiliate link is the first link in the description below. Please consider using my link to go and sign up for a free or paid account. If you use my link, I can get a commission for sending you over to them. It is what I use myself to assess these companies, and you can see how effective it is in identifying key drivers in a short 10-minute period. Thank you for listening, and until next time, stop paying fees, start building wealth.